The Dow jumped 955 points on Tuesday because markets believed the Iran war was ending. On Thursday, Brent crude hit $142, its highest since 2008, because Trump confirmed it was not. Both moves happened in the same week, driven by the same waterway that never actually reopened. The Strait of Hormuz has been effectively closed for over a month. Roughly 1/5 of global oil supply remains bottlenecked there, along with LNG slows, fertilizer feedstock, and petrochemical inputs. Brent surged 51% in March alone, surpassing the record monthly gain from September 1990. National average gasoline prices in the U.S. reached $4.06. UK factory input costs posted their largest monthly surge since 1992. The week ended with oil above 100, equities whipsawed by political statements, and central banks on both sides of the Atlantic publicly refusing to respond with the tool markets expected them to use. The choke point that compounds. The Strait of Hormuz carries more than crude oil. It carries the feedstock for diesel, jet fuel, fertilizer, and polyethylene, the plastic embedded in food packaging, detergent, and agriculture. Nobel laureate Paul Krugman noted gasoline is less than half of what households consume from petroleum. Add diesel, plastics, and fertilizer pass-through, and the real inflation shock is at minimum double the pump price. Moody's framed the cumulative burden as a tax. Americans paid an estimated $8.4 billion extra on gasoline alone in the first month of the war, before counting downstream manufacturing and food production costs. The burden concentrates in lower-income households, who spend proportionally more on transport and food. Shipping expert Lars Jensen, former director at Maersk, warned that even if the strait reopened tomorrow, shortages would persist for 6 to 12 months. The pipeline of tankers already at sea must empty before normal flows resume. This is not a disruption that reverses on a ceasefire headline. Central banks in the trap. The oil shock created a textbook case for rate hikes. Energy inflation was feeding into headline CPI. The OECD raised its U.S. inflation forecast, and bond markets moved on their own. The 10-year Treasury yield climbed 47 basis points in 5 weeks without Fed action. Powell's response was deliberate inaction. His argument, rate hikes take 12 to 18 months to work through the economy. By the time tighter policy landed, the oil shock would likely be over, leaving the Fed confessing a weakened economy for no gain. Kansas City Fed President Schmidt challenged that framing publicly, warning inflation could get stuck near 3%. The St. Louis Fed added a secondary pressure. AI capital expenditure is generating demand-side inflation independent of the oil shock. Households spending ahead of expected productivity gains. Businesses investing aggressively in infrastructure. Oracle laid off an estimated 30,000 workers to fund AI data centers, while securing $16 billion in financing for a single facility. That demand layer does not reverse when Hormuz reopens. The Bank of England faced the same bind from a structurally weaker position. Governor Bailey cautiously musters not to count on further rate increases, while simultaneously acknowledging inflation expectations had shifted enough to put hikes back on the table. Both central banks chose patience, and both are now hostage to an oil price they cannot control. The signal that kept moving markets. The week's equity moves were almost entirely driven by political statements rather than physical developments. On Tuesday, Trump told the New York Post the U.S. would not be in Iran too much longer, and unconfirmed reports suggested Iran's president was open to a deal. The S&P 500 rose 2.4%, Nasdaq surged 3.3%. The same day, Brent climbed to $120 because the strait was still closed and 1/5 of global oil supply still could not flow. On Wednesday, Trump's address was priced as a potential off-ramp. Brent dropped 8% intraday. By Thursday, he publicly committed to more weeks of military strikes, describing further attacks and offering no timeline for reopening Hormuz. Brent jumped more than 8% to close above $109. WTI briefly traded above Brent, a rare inversion traders read as a signal that seaborne oil was becoming structurally unreliable, forcing buyers toward landlocked supply. JP Morgan's Jamie Dimon summarized the underlying problem. The U.S. must finish this thing and clean up the straits, warning that any withdrawal without reopening the waterway leaves the global economy permanently exposed. Month-end pension rebalancing amplified Tuesday's gains. That mechanical bid does not repeat in April. Signum Global Advisors described a verified ceasefire with explicit Hormuz terms as extremely unlikely in the near term. Each time markets rallied on a political signal, the physical constraint that caused the rally's premise remained unchanged. UK, the rate mortgage transmission. The war's transmission into the UK economy runs through a specific mechanism. Oil above $100 lifts headline inflation, which constrains Bank of England rate cuts, which keeps swap rates elevated, which lenders pass directly into fixed mortgage pricing. That chain moved faster than the BOE's formal policy process. HSBC raised its 2-year fixed rate from 4.57% to 5.17% in a single week. The market average reached 5.84%. Lenders pulled approximately 1,500 products from the market. The BOE's Financial Policy Committee estimated 5.2 million UK mortgage holders face higher repayments by 2028, up from 3.9 million before the conflict. The housing market had not yet absorbed this repricing. Nationwide's March data showed the strongest monthly price gain in 15 months, reflecting decisions made before the rate shift. Those locked-in mortgage offers expire this spring and summer, when the reset hits transaction volumes. House builders moved first in equity markets. Berkeley Group halted all new land purchases and cut medium-term profit guidance by 20%. Taylor Wimpey fell 5%, Barrett Redrow dropped 4%. When the most sophisticated operator in UK house building stops acquiring land entirely, it signals a structural reassessment of demand. The only FTSE winners were energy majors. BP gained 24.5% in March. Shell shares hit record highs. The war bifurcated the UK equity market cleanly on one axis, exposure to oil. The week established a pattern that is likely to define April's early sessions. Political statements will continue to move markets intraday, but the physical constraint, Hormuz remaining closed, will continue to re-anchor oil above levels that keep central banks frozen. The weight of evidence points toward continued stagflationary pressure, elevated input costs, a Fed and BOE that have publicly committed to patience, and a Hormuz closure that structural experts say cannot be reversed quickly even with a ceasefire agreement. That lean holds only if two conditions persist. Oil stays above 90 and no verified ceasefire with explicit Hormuz reopening terms emerges before mid-April. The recovery scenario is genuine, not token. If Trump's withdrawal timeline materializes into a negotiated reopening of the strait, the fertilizer and petrochemical input chains reverse within weeks. Insurance costs for tankers drop. Asian refiners exit spot markets. The inflation argument weakens materially, and the Fed's patience gets validated rather than challenged. That scenario's benchmark is Brent in the first 5 trading sessions of April. If it breaks and holds below $90, the de-escalation is real. If it holds above $100, the market's ceasefire optimism is still running ahead of physical reality. On the employment side, Friday's U.S. non-farm payrolls report carries asymmetric weight. If wage growth is running above 4% alongside current input costs, the stagflation case strengthens and the Fed's pause becomes harder to defend publicly. If payrolls disappoint materially, the dominant risk shifts from stagflation to outright recession, a scenario where the Fed cuts not because inflation is solved, but because growth collapsed first. The two outcomes require opposite positioning. Markets will enter next week without knowing which clock is correct.